Cryptocurrencies are known for their volatility. This makes them a prime targets for liquidation, the bugbear of crypto trading, occurring when an investor cannot meet the margin call on their leverage position. Traders increase the funds they can trade with by borrowing from a third party, in this case, an exchange. Although leverage or borrowing funds to increase trading positions can multiply potential profits, it's an extremely risky move. You could lose your initial margin or capital if the market moves against your leverage position. In this video, you'll learn what crypto liquidation means, how to avoid it, and what to do if it occurs. We'll also look at why volatile trading environments are more prone to liquidations. Let's get started. First of all, what's crypto liquidation? The term liquidation refers to the process of selling crypto assets for cash to minimize losses, especially in the event of a market crash. However, in the crypto space, the term liquidation is mainly used to describe the forced closure of a trader's position due to the partial or complete loss of the trader's initial margin. This occurs when the trader cannot meet the margin requirements for his leveraged position, i.e., he doesn't have sufficient funds to keep the trade open. The margin requirements are often insufficient when the price of the underlying asset suddenly falls. In this case, the exchange automatically closes the position, resulting in a loss for the investor. The size of this loss depends on the initial deposit made and the extent of the price decline. In some cases, this can lead to a total loss of the investment. Liquidation can be distinguished between partial and total liquidation. For example, there's partial liquidation, in which a position is partially closed early in order to reduce the position and the leverage used by the trader. Or there's full liquidation, which is a closing position where almost all the trader's initial margin has been used up. Liquidation can occur in both futures and cash trading. However, traders should be aware that when buying a contract, the price is derived from the asset, not the asset itself. This means that the profit and loss will fluctuate when converted back into the current price of the asset. So you might think, what's crypto margin trading? Crypto margin trading involves borrowing money from a crypto exchange to trade a larger volume of assets. This can provide the trader with greater buying power and the potential for greater profits. In other words, leverage means borrowing money to take a larger position than your own funds allow. However, there's also a higher risk associated with it, as leveraged positions can be liquidated quickly if the market moves against you. To open a trading position in margin trading, the exchange requires you to deposit a certain amount of cryptocurrency or fiat currency as collateral. These funds are used to protect the lender from losses in case the trade fails. The maintenance margin is referred to as the minimum margin required to keep a position open. Leverage is calculated based on the amount you can borrow from an exchange relative to your initial margin. Let's take a simple example. If you start with an initial margin of $1,000 and 10 times leverage, it means that you borrowed $9,000 to increase your trading position from $1,000 to $10,000. The degree of leverage also determines the potential of a trade to make or lose money. If you use the above example of 10x leverage and the price of your asset increases by 5%, you'll have made a profit of $500 on your trading position. This means that if the price goes up by only 5%, you'll have made a profit of 50% of your original margin of $1,000. Sounds lucrative, right? But cryptocurrencies are notoriously volatile, and the price of your asset could crash at any moment. To stick with the example above, if the price of your asset falls by 50%, you'll have lost $500, or 50% of your initial margin. An important note about crypto margin trading: when positions are liquidated, they're always closed at the current market price. Their losses are magnified by the size of the leveraged position. In other words, if the trader loses $1,000 from the open position of $10,000, he's lost his entire initial margin. So it's important to be aware of the risks before borrowing money to trade cryptocurrencies. Then our main point: how does liquidation of cryptocurrencies occur? Liquidation takes place when an exchange or broker closes a trader's position because it can no longer meet margin requirements. Margin is the percentage of the total trade value that must be deposited with the broker to open and hold a position. When a trader's margin account falls below a previously agreed level with the exchange, positions are automatically liquidated. If your leverage position reached the liquidation threshold, you'll have to make a margin call, i.e., you'll have to deposit more margin. This means that you'll have to make more margin calls. Liquidation usually occurs more frequently in futures contracts where traders use higher leverage. At this point, there are two options. Either you can increase your margin to bring your leverage back above the required leverage, or the broker will automatically liquidate your position. Let's stick with our example with an initial margin of $1,000. Let's say you made a trade with 10x leverage, which means your leverage position is now $10,000. That's $1,000 of your own money and $9,000 that you borrowed from the exchange. Let's say your BTC has fallen by 10%. Your position is now worth $9,000. If the price decline continues and the losses of the position increase, they'd be transferred to the borrowed capital. To avoid losses on the borrowed capital, the exchange would then liquidate your position to protect the money lent to you. Your position is closed, and so is your initial capital of $1,000. But that's not all. Exchanges usually charge a liquidation fee. This is to get traders to close their positions before they're automatically liquidated. The important point is that leverage works both ways. Higher leverage makes you more money when the trade is going well, but it only takes a small negative price movement to trigger a liquidation event. For example, in a trading position with 50x leverage, only a 2% drop in price is required to trigger a liquidation event. However, there are also cases where exchanges such as Bybit offer a maintenance margin set at 0.5% of the bankruptcy price instead of the entire price. This also means that a trader's position won't be partially liquidated, but only if the initial margin is still 0.5%. If you still need to use leverage, you should limit yourself to an amount that you can manage. Explanation of the liquidation price. The liquidation price is a point at which your leveraged positions are automatically closed. The factors that affect this threshold include the leverage used, the amount of collateral, the price of the cryptocurrency, and the remaining balance in your account. The exchanges will calculate the liquidation price for you, and it may be an average value from several major exchanges. When the price of your cryptocurrency exceeds the liquidation price threshold, it triggers the liquidation process. Cryptocurrency prices are constantly changing, so it's important to keep up to date with the latest news and make sure that your positions are still yielding a profit. Otherwise, you may find yourself automatically liquidating at a loss. And of course, we can give some examples. There may be times when a trader needs to liquidate his Bitcoin to cover a short position or meet other financial obligations. In this case, the trader usually sells his Bitcoin at the current market price, regardless of whether it's above or below the original purchase price. However, in some cases, a trader may be forced to sell his Bitcoin at a price lower than the market price. This may be the liquidation price, which is usually determined by the exchange on which the Bitcoin is sold. In early January, when Bitcoin fell below 43K, over $812 million worth of crypto futures were liquidated, resulting in large losses for long crypto traders. This happened due to a partial or total loss of traders' margin deposits. It's important to note that liquidation price can change at any time, depending on the current market conditions. So, if you're thinking about selling your Bitcoin, it's always a good idea to check the latest liquidation price before making a final decision. This way, you can make sure that you get the best possible deal. And with that, you now know everything to avoid or go into, while making sure you're safe. For more videos like this, make sure to subscribe to our YouTube channel, Hungry Dollar, for more videos like this. Also, see you in the next video. Goodbye.